All right, welcome to today's Explainer. I'm putting on my equity research analyst hat right now, and we are going to completely ignore the sensational headlines you've been seeing. Nutex Health just posted what looks like a massive Q2 2026 earnings beat. I mean, EPS hit $9.38 against a $4.88 forecast, and the stock popped 11% to $187.60. But is that price actually justified? Well, to find out, we're going to run this stock through a brutal, unforgiving quantitative obstacle course.
Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Here is our agenda for today's gauntlet. Section 1, the ultimate valuation gauntlet. Section 2, the media blackout flags. Section 3, legendary investors reality check. And finally, Section 4, moat and synthesis, where we'll give our final verdict. Let's get right into it. Section 1, the ultimate valuation gauntlet. Stress testing 21 models. We're stripping away all the emotion here and running NUTX's first half 2026 fundamentals through an unforgiving mathematical gauntlet.
Starting with cash flow, the sheer cash generation power here is pretty striking. With a 26% free cash flow yield and $109.7 million in operating cash flow for the first half of the year, these discounted models suggest some serious upside from that current $187 price tag. A standard discounted cash flow using their weighted average cost of capital points to $210. If we look at unlevered free cash flow, which strips out the impacts of debt, it sits at $205. Free cash flow to the firm yields $215, and free cash flow to equity, which really measures true shareholder value, hits $220. Finally, the adjusted present value, which factors in the tax shields on their very manageable $31.1 million in debt, lands right back at $210.
Moving on to our dividend and income models. Now, because NUTX pays absolutely zero dividends, your standard dividend discount model, the Gordon growth model, and the multi-stage DDM all spit out a big fat zero. They just don't apply here. But take a look at the residual income model. By combining their book value with their excess earnings, which is driven by a frankly staggering 57% return on equity over the trailing 12 months, the RIM values the stock at $190. Similarly, the economic value added model, which compares their massive $121.7 million Q2 operating profit against their capital charge, points to an intrinsic value of $200.
Now here's where the math gets a little bit distorted by the headlines. Comparable company analysis and precedent transactions put them slightly below current trading levels, at $180 and $175 respectively. But those PE and EV to EBITDA multiples, they are absolutely warped by that huge $9.38 Q2 EPS and a 3,100% net income surge. And spoiler alert, that surge relied heavily on a stock-based compensation reversal. Because of that weirdness, the PE model suggests a sky-high $250, and EV to EBITDA suggests $230. The price to book, using sector averages, hits $185, and EV to sales points to $190, showing us that despite a 13.6% revenue drop in Q2, their margin expansion actually supports the current price.
All right, let's look at the hard assets. The raw book value is $74.16, with net asset value sitting right next to it at $75. Now, a fire sale liquidation value is pretty ugly at just $30 a share. The key takeaway there is that it's heavily dragged down by $112.9 million in non-controlling interests. If you had to rebuild their 27 hospitals today, replacement cost sits around $100. But check out this kicker. Real options valuation. Using Black-Scholes logic to value their growth projects, specifically those 3 new hospitals opening in late 2026 in West Little Rock, San Antonio, and Jacksonville, the value skyrockets to $240 a share. Section 2, the media blackout flags, buried in the footnotes. So the models are mostly screaming undervalued. But remember, we're acting as investigative journalists of financial statements here. We're going to ignore the flashy revenue and EPS headlines and dig into the 10Q footnotes for the real story.
Let's uncover 7 deep red flags you definitely won't hear on the news. First, they rely heavily on the federal independent dispute resolution process for over half their claims, a detail that is just too legally dense for a quick headline. Second, while the media obsessed over that massive EPS beat, they completely glossed over the fact that Q2 revenue actually missed estimates by 2%.
Third, digging into the balance sheet, you'll find a massive $112.9 million in non-controlling interests. Fourth, accrued arbitration expenses remain stubbornly high at $49.6 million. Partnership and liability accounting like that puts retail investors asleep, so the media skips it. Fifth, qualifying payment amount benchmarks remain stubbornly low. Sixth, general and administrative expenses actually rose, hiding behind operating income. And seventh, they're sitting on $29.2 million in long-term operating lease liabilities. Put it all together, and it's a minefield of data that doesn't fit into a 30-second TV segment.
But hey, the media's missing the green flags too. For instance, flag number 1, a massive $205.2 million cash pile. Flag 2, they reversed over $100 million in stock-based compensation into a $1 million gain. The talking heads completely missed that because it requires actually reading year-over-year footnotes. Flag 3, return on equity hit an amazing 57%. Flag 4, operating cash flow surged 40% to $109.7 million. Flag 5, arbitration costs are finally dropping into the high teens and low 20s. Flag 6, patient visits and acuity jumped 9.6% year-over-year. And Flag 7, a staggering free cash flow yield of 26%. These are massive operational wins, but calculating unlevered free cash flow yields just requires way too much math for cable news.
Section 3, Legendary Investors Reality Check, looking at Graham, Lynch, and Buffett. Let's take a step back and look at the big picture through the eyes of the legends, comparing the current price to their strict methodologies.
So how would the all-time greats play this? Ben Graham, the father of value investing, relies on the Graham number, which blends earnings and book value. Our calculated Graham number here is $230.14. Since the current price is well below that and their PE is incredibly low right now, Graham would easily pass this on a pure value test. Next up, Peter Lynch. He loves growth at a reasonable price. By calculating the PG ratio, that's price to earnings divided by growth, we get a stunningly low 0.23. Lynch's rule of thumb says anything under 1 is a buy, indicating massive growth at a steep discount. Finally, Warren Buffett. He would absolutely salivate over that 57% return on equity and their incredible cash generation. However, he might raise an eyebrow at their heavy reliance on federal arbitration for revenue, and he'd probably question the long-term durability of their moat.
Section 4, Moat and Synthesis. The final verdict. It's time to tie it all together and synthesize this forensic accounting data into an objective verdict. We've run the numbers, we've read the footnotes, and we've consulted the ghosts of Wall Street.
First up, valuation. Based on the rigorous application and averaging of all 21 financial models we ran, from the standard WACC DCF all the way to the Black-Scholes real options, the average intrinsic value lands at $212.40. Therefore, at roughly $187 today, the stock is distinctly undervalued, and this discount is heavily supported by their massive cash generation, collapsing arbitration expenses, and that clean reversal of stock-based compensation overhead. Second, let's define their economic moat. Using Morningstar's 5 sources of moat, NUTX displays a narrow but notably expanding moat. Their advantage doesn't come from switching costs or brand recognition, but primarily from intangible assets, specifically their localized regulatory navigation, along with solid pricing power. And this moat is actively expanding over the next 3 years, because recent federal court wins in multiple states are legally reinforcing their out-of-network independent dispute resolution strategy, which essentially forces insurers to pay up. So here is our nuanced takeaway. Nutex Health is generating spectacular, undeniable cash flow, and their legal pipeline for out-of-network billing is definitely strengthening. The math is incredibly bullish, but on the flip side, they are operating in a highly combative regulatory environment against massive insurance companies, and their balance sheet carries heavy non-controlling interests that really complicate true equity value. The quantitative models are confidently pointing one way, but those hidden balance sheet flags suggest a potential storm brewing. Which side are you on? Do your own homework.